Hi there, welcome to week 10. My name is Iji Ogeho. In this lecture, we will consider interpretation of financial statements and ratio analysis. These are the areas that I will consider in this lecture. We'll first look at introduction to ratio analysis and then consider the categories, the types of ratio. There are four main categories that we're going to look at, which are profitability ratios, liquidity ratios, efficiency ratios, and investment ratios. Then I would look at the limitations of ratio analysis and conclude by looking at multivariate analysis. To put the importance of this particular topic into perspective, what if I were to say to you that a company has made turnover of £1 million? You would say great. And of course, £1 million is great. However, if I were to further add that the company made £5 million last year, then the £1 million is not so great after all. Why? Because the performance this year has been markedly less than the turnover of last year. So relatively, the company has performed poorly. This is the importance of ratio analysis. Figures, accounting figures, are very important indeed. However, the figures alone will not suffice to make meaningful decision or economic decision. We need to put those figures into relative terms by comparing them perhaps with the prior year figures or with similar company or with perhaps a budget or industry average. Only then we can make a decision as to the company's performance as well as position. So therefore, in introduction, the financial statements themselves provide very useful information to varying degrees of users. The users have varying needs for information. And of course, in order to satisfy their desire to make useful economic decision, the users need to be able to analyze the financial statements and therefore draw informed conclusions with regards to the company's performance as well as the financial position of the company. Ratio analysis is a technique that enables this to happen. It does provide the ability to analyze financial statements with a view to making economic decisions. With accounting ratios, once calculated, you can compare one period with another, or perhaps compare the company's results with a similar company of the same industrial size, or perhaps with industrial average, or maybe perhaps with budget. Now that we have introduced the importance of ratio analysis, we're going to look at the four main categories of ratios. The first main one is profitability ratio, liquidity ratios, efficiency ratios, and investment ratios. Let us first consider profitability ratios, where the word profitability focuses on the profits which the company makes. So therefore, we need to be able to assess the performance of the company as well as its efficiency of operation. So therefore, the profitability ratios will help us to show the relationship between the profit as well as the resources employed by the company in its operations. There are four main types of profitability ratios, the most important of which is return on capital employed, ROCE. Then we've also got return on equity, ROE, gross profit margin, and net profit margin. Let me now focus first of all on the ROCE, return on capital employed. The calculation of this ratio is relatively straightforward. So you take the profit before long-term interest and tax. So in other words, the profit before taxation after finance charges in the statement of profit or loss account. You divide that by the capital employed. The capital employed can be derived in one of two ways. It is the equity, i.e. shareholder share capital plus reserve, plus non-current liabilities. Alternatively, you can also derive the capital employed by taking the total assets of the company less current liabilities. So you understand that. So either you take the equities, in other words, share capital and reserve, plus non-current liabilities, which are long-term liabilities. Alternatively, you can take the total assets of the company less current liabilities. The return on capital employed is a very important ratio, and it is normally expressed as a percentage. In other words, you multiply it by 100 to get a percentage. It is single percentage that explains the performance of a company. There are a few versions of it. What this version does is to interpret the capital employed as the total amount of money invested in the company in the long term, regardless of whether this capital is coming from shareholders or from long-term creditors or long-term providers of finance, lenders or shareholders. So it does not matter. But remember that we take out current liabilities, which is merely for the short term. Sometimes the return on capital employed is referred to as return on assets, and as I said earlier, it is expressed as a percentage. We can also calculate the return on capital employed as a product of two ratios. And these are the following. These are profit over sales, which is the profitability ratios, profit ratios, times sales over net assets. Now the PBIT is a profit before interest and tax that we referred to earlier. If you divide that by sales, that gives us the profit ratio, the profitability of the company. Whereas the sales over net assets being total assets less current liabilities, will give us the asset utilization. So if you multiply these two ratios together, that will give us a return on capital employed. And as you can see that in this calculation, this multiplication, the sales cancels out with the sales, which leaves us with the formula we had earlier. The profit before interest and tax divided by sales is one version of this ratio, which we refer to as the profit margin, whereas the sales over net asset is referred to as the asset turnover. That is the asset turnover ratio. So therefore, the return on capital employed is profit margin multiplied that by the asset turnover. In effect, what this means is that if there is a change in the ROCE, the return on capital employed, that change can be explained either by a change in the profit margin or a change in the asset utilization or both. The next set of ratio calculation under the profitability ratios is return on equity, ROE. Now, of course, this focuses mostly on equity providers. Because the focus is on equity provider, we are taking the profit that is available for distribution to the equity shareholders. Hence, we take the profit after tax less dividends. So profit after tax after dividends divided by equity. Equity being ordinary share capital plus reserves. This ratio concentrates on the return available to the ordinary shareholders. It may also be classed as an investment ratio because the ordinary shareholders are investors in the company. And of course, this ratio is expressed as a percentage by multiplying the calculation by 100. The other types of gross margin ratios are the gross profit ratio and the net profit margins. The gross profit margin is simply gross profit over sales, and the net profit margin is net profit over sales. So the net profit in this instance, or profit in this instance, would be the profit before interest and tax, PBIT. It is also possible here to drill down on this ratio by taking every line of expenses and dividing that by sales to see which line of expenses has a bit of an outliner. The profit figure used in the calculation of net profit margin is usually before profit before tax, but other profit figures might also be used. As before, these ratios are expressed as percentages. So that is the return on the profitability ratios. Now, of course, the higher the profitability ratios, the more that the company is performing well. So it shows that the company has performed well during the period or in comparison to the industry average, the budget, or similar company of the same size in the same industry. The next set of ratios we are going to consider are liquidity ratios. The word liquid simply means cash. It means what cash has the company available to make immediate payments. So a company therefore must have sufficient liquid assets to meet its debts when they fall due. So in this case, we will use all these ratios to assess the amount of cash that a company can put its hand on very quickly to settle its debts when needed. Now, of course, liquid assets are cash, short-term investments like money market funds, current deposit with bank, accounts receivables, bills of exchange. These are merely liquid cash. Now, we are talking about short-term as liabilities here to settle short-term debts such as payables, current tax payables, and the likes. There are mainly two types of liquidity ratios. These are current ratios and quick asset ratios. Let's look at these two in turn now. Current ratio. Basically, you take the current assets of the entity and divide that by the current liabilities. Now, of course, the current assets will include inventory, receivables, bank account, and the likes. You divide that by current liabilities, and you express this as a ratio, not as a percentage. So, for example, it could be 2 to 1 or 1.5 to 1. The norm is usually 2 to 1 for this ratio. Now, of course, for different industries, they may have different norms. It will not be the same norm for a manufacturing industry compared to a retailer. But when this ratio increases, if it is high, it simply means that the company has enough current assets to pay its debts when they fall due. So if we've got an answer of 2 to 1, it means for every £1 liability, the company has got £2 of current assets, so twice that amount to pay off the liability. As I said, the higher the amount, the better. However, if the amount is too high, it may be an evidence of the company's inability to manage its treasury. So the money that is being tied in current asset could have been utilized in better investment that will yield better return. So therefore, a company needs to look at the current ratios and make sure that it is managing its treasury well. The second part of this ratio is quick asset ratio, often called acid test ratio. Now, this ratio is important because the current assets includes inventory. Now, inventories take some time to sell. So if you're trying to satisfy your debt relatively quickly, you may not be able to sell your inventory in time to do so. So we need to measure the company's ability to settle its debts very quickly without having to sell its inventories. Hence, this is current assets less inventories divided by current liabilities. Usually the norm for this is 1:1. So in other words, the company ought to have at least £1 of current asset to settle £1 of current liabilities when they fall due. Again, it differs from industry to industry. So far, we have looked at two categories of ratios, which is the profitability ratios and now the liquidity ratios. Let us now look into the efficiency ratios. The efficiency ratios are used to assess the extent to which management is able to manage the assets and to use them to make high returns. So the assets at the disposal of the entity, how well is the entity able to manage them in order to make high returns? This ratio will focus on that aspect of our analysis. The key ratios that we will consider are asset turnover, which I've mentioned earlier, inventory holding period, receivables collection period, and payables payment period. For asset turnover, this is sales over net asset. If you remember, net asset was total assets less current liability, or equity plus non-current liability. This ratio expresses how well the assets are utilized in turnovers and sales. It is expressed as a ratio, not as a percentage. If this ratio increases, it means therefore that the company is utilizing its asset well. Now, one needs to be careful, especially if it has decreased dramatically. So we need to investigate further to see why it has decreased. Could it be that the company has acquired more non-current asset at the end or close to the end of the period, and the non-current asset has not yet started to yield profits? Well, that may explain it. Or it could be that there is huge amount of intangible assets that has been valued, which may have increased the amount of assets, the denominator, thereby reducing the ratio. Again, by calculating this ratio, there is a trigger for further investigation to find out why the ratio has fallen, whether the assets are being efficiently turned over. The other types of efficiency ratios are mainly for working capital management. So these are basically ratios that cover inventory, receivables, and payables. These ratios have different types, different forms of calculation, but I'm going to focus on the holding period calculation. Look in your textbook, you see the different varying forms of calculations for these types of ratios. So with the inventory holding period in days, that is average inventory divided by cost of sales. Well, there are variations of this. You could use the inventory at the end of the year rather than average inventory. And you could also use purchases instead of cost of sales. But of course, if you haven't got these figures of purchases, cost of sales will suffice. If you multiply it by 365, that gives you the number of days. If you multiply it by 52, that gives you the number of weeks holding period. If you multiply it by 12, you will get the number of months holding period. But the most common one is the number of days holding periods. Hence, we multiply by 365. Now, of course, if this has increased, it may indicate that we are holding our inventory for much longer. So we then need to investigate why we are holding our inventory for much longer. Could it be we are stockpiling because we are anticipating a huge increase in sales? Could it be that we are not selling as much as we should be? Then there is the possibility of obsolescence by virtue of us carrying huge amount of inventory. And of course, the storage costs will eat into our profitability. But calculating this ratio does highlight the importance for further investigation to see why there is a change. The second working capital ratios will be receivables collection period. And this is calculated as the average trade receivables divided by credit sales. Again, with this ratio, you can use the trade receivables at the end of the year instead of average receivables. And of course, you can use the sales or turnover figure instead of credit sales if you don't have credit sales. And of course, if you wanted to calculate this per week, the collection period in weeks, you will multiply that by 52 and by 12 if you're calculating it in months. Now, the higher this amount is, indicates the longer it is taking for you to collect your receivables. This may be indicative of bad credit management. So then we need to look into our credit management policy to see whether or not we are chasing our debtors as and when due. Or is it possible that we are given longer credits in order to increase our sales? Or maybe perhaps we may consider invoice discounting. But this ratio will give us some pointers as to the direction we are heading. Now, of course, if the ratio has reduced quite dramatically, again, we may need to look into this. It may be that we have very good credit control system in place, or perhaps we are not given enough credit, which may turn away our customers. Again, we need to look into that. Finally, we have the payables period. This is calculated as the average trade payables divided by credit purchases. Again, instead of using the average, we could use the trade payables at the end of the period. And if we don't have the figures for credit purchases, we could use cost of sales instead. And again, we multiply that by 365 if we are working in days, or 52 if we are working in weeks, or 12 if monthly. Now, with trade creditors, that is free credit because as a company, you receive finances without paying interest on it. So therefore, that will indicate or suggest that the higher the trade creditor, the better. The payables period, the better. So if you can increase the payables period, you are obtaining finances. However, it may be that your creditors will not permit this. So you may do this at the expense of future credits. So they may view you as bad payers as a result, and therefore may not extend credit to you in the future. Alternatively, when this figure increases, that could be indicative of financial crisis, that you are unable to pay your credits as they fall due. So again, we need to first of all calculate this and then investigate how long it takes or the reason for the differences or movements in this ratio. Let me state that it is often a good working capital management technique to ensure that the receivables collection period are shorter than the payables payment period. This means that you are able to collect your receivables, having therefore enough fund to pay your payables. Of course, many companies will want to adopt similar policies, and therefore one needs to be careful how this is applied. The final thing that I want to say here is that we may have to calculate a cash conversion cycle, CCC, the cash conversion cycle. This is simply the inventory days plus the receivable days less the payment days. So that obviously display how long it takes to acquire the inventories, sell the products or the goods, and receive the money. So the lower the cash conversion period, the better it is as far as cash management is concerned for the company. Final ratios that we will now consider is investment ratios. The investment ratios focus on investors and analysts. They will need these ratios to assess the value and of course the quality of their investment in ordinary shares of a company. The key of these ratios are earnings per share, price earnings ratio, dividend cover ratio, dividend yield, capital gearing, and interest cover. Let us look at these ratios one by one. Earnings per share. The earnings per share is profit after tax, after preference dividends. Again, this is profits attributable to equity shareholders, to ordinary shareholders. So the profit after tax, after preference dividends, you divide that by the number of ordinary shares in issue by the company. You multiply that by 100 in order to express it in pence. The earnings per share is a subject of International Accounting Standards 33. This is not part of your syllabus, but of course, this is explained further in chapter 23 of your recommended text. The second very important ratio is a price earnings ratio. This ratio is used for the valuation of shares and company valuations. It is simply the market price of ordinary shares per share divided by the earnings per share. So once you've calculated your earnings per share, then you have the market price per share. You divide the market price per share over the earnings per share. Alternatively, is the market value of a company divided by their total earnings. That will give us the price earnings ratio. Now, of course, we are able to price a company by simply reversing the calculation of this ratio. To get the market price of a share, you take the P ratio and you multiply that by the earnings per share or EPS. And this is normally used for company valuation. The P is expressed as a ratio, so it's not a percentage. The higher the P ratios, then the greater the favorable view of the market for the company. Whereas lower P ratios indicates that the market does not view this company quite favorably. So when the ratio increases, it's indicative that the market has confidence in the company. Dividend cover and yield. For the dividend cover, basically show how much profit is available to pay dividends. So it is a profit after tax or including after preference dividends. In other words, the profits available to ordinary shareholders divided by the ordinary dividends paid. The dividend yield is a reciprocal of the dividend cover. Basically, it's the dividends per ordinary share divided by market price per ordinary share. The dividend cover is expressed as a ratio, whereas the dividend yield is expressed as a percentage. Gearing and interest cover. Capital gearing looks at the ratio of debt to equity. In other words, gearing indicates how much debt the company is bearing. So, in this instance, preference share capital are regarded as debt. So that would be the preference share capital plus non-current liabilities divide that by the total share capital plus reserve, which is equity, plus non-current liabilities. Again, another expression of this would be the preference share capital plus non-current liabilities divided by the equity, which is share capital plus reserves. Whichever form of this calculation is used must be used consistently. The higher the gearing ratio, the more likely that the company may face financial distress in terms of serviceability of its loan. In other words, whether the company makes profit or not, interest must be paid. So the higher the gearing, the more interest that the company will have to pay. And these are obligatory and therefore may put financial stress on the company. So therefore, this is very important ratio from the company's perspective, in the sense that if the company has higher gearing, it may not be able to raise finance or more loans in the future. If indeed any company is willing to provide loans, then they would do so at a higher rate of interest because of the additional risk that they bear. The risks of the equity shareholders will also increase because the profit which otherwise would have been available for payment of their dividend now goes towards the payment of interest, and therefore their risk will increase. So higher gearing is usually a sign of trouble for companies. When you calculate capital gearing ratio, then it is important to see whether the company is going through problems or stress in terms of payment of interest. You do that by calculating interest cover. Interest cover is a profit before interest and tax divided by interest payable. The higher the interest cover, the more likely company is able to pay its interest when they fall due. So oftentimes when the capital gearing increases, always attempt to calculate the interest cover as well to see how much profit is available to meet and pay interest when they fall due. The capital gearing is expressed as a percentage and the interest cover is expressed as a ratio. That concludes the main types of ratio analysis or ratio calculations. As I said earlier, the calculation is merely to pinpoint areas for further investigation. So when you calculate the ratios, they obviously give a pointer as to what the financial position or the financial performance of the company might be. One thing is to calculate it, another is to be able to interpret those ratios in order to come to an economic decision. For such an interpretation, further investigation, as I said earlier, will be required. Ratios are very good. They are excellent, as we have explained earlier. They take a relative view or perspective of financial information so that you are able to compare one period with another or compare the results of a company with similar company in similar industry with industrial average or perhaps with a budget. However, they have limitations. Well, the figures calculated are based on past results that have already transpired, and they are calculated based on that. And past performance is not always a good indicator of future performance. For example, in recent times, we're going through this issue of coronavirus, and because of that, many businesses have shut down. This would not have been captured by past information. And so we need to be aware of such a fact that as good as ratios are, they are based on past performance, which are not necessarily a good indicator of future performance. And there may also be some other external influences that may impact on the performance and position of a company. Ratios quantify what has happened. It tells us that the profit has fallen or risen, but does not tell us why. This is why further investigations will be required. There's a lack of standard definitions. If you remember, for example, in the inventory days, I said inventory holding period. I said you could either use the end of period inventory or the average. Again, there are other ratios with different types or definitions. So there is no standard definitions, and each method you use will produce different answer. And figures taken from the financial statements, especially statement of financial position, may not be representative of the reality of things, depending upon what has actually been entered into the financial statements. So that may be quite unrepresentative, yet the calculations are based on them. Accounting policies may differ. Depending on your accounting policies that you have adopted, you would have different answers. And again, accounting estimates may differ, and they will also produce different answers, and therefore the ratios will be different. And finally, the ratios calculated may be misinterpreted, so there may be misinterpretation of this ratio after they have been calculated, and therefore drawing wrong conclusions. These are the limitations of ratios, and we need to be aware of these. Finally, we'll look at multivariate ratio analysis. Now, this is a standard measure whereby key ratios are weighted. They are then combined to produce a single index number, and this index number represents the financial health of the company. It is claimed that this technique can be used to predict a company's or corporate failure. There are many variations of multivariate ratio analysis, but we quickly mention the Z-score analysis. The Ottmar Z-score is one that brings together some key ratios and applies some weightings to them. So in that calculation, Z is equals to 3.3A plus 1.0B plus 0.6C plus 1.2D plus 1.4E. So where A is the earnings before interest and tax divided by total assets. So you calculate this ratio, earnings before interest and tax divided by total assets, and you multiply that by 3.3. B is the sales divided by total assets. Once you've calculated that figure, you multiply it by 1, which is the same. C is the market value of equity divided by total liabilities, and you multiply that by 0.6. D is working capital divided by total assets, you multiply that by 1.2. And finally, E is retained earnings divided by total assets, multiply that by 1.4. Then you add all of them together to produce Z-score. We have concluded this session on ratio analysis. As I said from the beginning, ratio analysis is very important. Looking at the figures presented in financial statements is good. However, we need to apply some relative measures by putting them in perspective, and ratio analysis enables us to do just that. We discuss 4 key ratios, which are profitability ratios, liquidity ratios, efficiency ratios, and investment ratios. We also discussed that we should not put all our trust in ratio completely because there are limitations. Important of this is that they're based on past performance, which are not necessarily a predictor of future performance. And then finally, we looked at Ottmar Z-score by looking at a single index to try and predict corporate failure. So this week you can see that ratio analysis are very important. There are other aspects that we have not considered in this session, which is merely the interpretation of accounts by looking at trend analysis, vertical analysis, and the likes, but these are not part of your syllabus. During this seminar session, you will have the opportunity to practice questions, which we will do as part of our seminar. I hope you have understood this lecture so far. Feel free to send me your questions as usual, and I'll be more than happy to answer them. So I'll say to you, stay safe, be good, and remain healthy until we meet again. Thank you very much.